Watch closely when a stock appears dead. That's often when the smartest money is accumulating. During this refueling phase, shares transfer from weak hands to strong. Volume dries up, volatility compresses, and the uninformed grow impatient. But beneath this quiet surface, institutional operators are methodically building position. When this absorption completes, the spring releases and stocks can double with explosive force. For example, study the 1942 to 1949 base in U.S. steel. 7 years of sideways action tested every trader's patience. Yet during this accumulation, insider buying quietly increased. When the breakout finally came in 1950, the stock doubled within 18 months, rewarding those who recognized the refueling pattern. The public, my dear student of the markets, is forever chasing yesterday's winners. They buy when newspapers trumpet success, when tips flow freely at dinner parties, when excitement permeates the financial district. But this is precisely when the intelligent operator is distributing his holdings to these enthusiastic buyers. No, the real opportunity, the foundation upon which fortunes are built, occurs in the quiet periods that most traders find unbearably dull. Observe a stock that has declined substantially. The public, having suffered losses, wants nothing to do with it. The financial press has moved on to more exciting stories. Trading volume has dried to a trickle. The price meanders sideways, day after day, week after week, trapped in what appears to be a lifeless range. To the untrained eye, this stock is dead money, a waste of capital that could be deployed elsewhere. But what is really happening during this period of apparent inactivity? The large operators, those who move markets through their substantial capital, are methodically accumulating shares. They cannot buy all at once. A sudden surge of buying would drive prices up sharply, forcing them to pay increasingly higher prices for their position. This defeats their purpose entirely. No, they must be patient, surgical, and above all, quiet. These professionals absorb shares slowly. When weak holders, tired of waiting, finally capitulate and sell, the operators are there to buy. When a minor rally brings hope and a few shares are offered, they buy again. Day by day, they accumulate their line, carefully keeping price within a range that doesn't attract attention or competition. Study the tape during these periods. You'll notice something peculiar. When price dips toward the lower end of the range, volume often diminishes. This tells you there's no real selling pressure, no supply pressing down. When price lifts toward the upper range, you may see subtle volume increases. This is absorption occurring. Strong hands are taking shares from weak hands. The trading range itself is the accumulation zone, a battlefield where the transfer of ownership occurs. The wider this range and the longer time spent within it, the more shares change hands and the more substantial the position being built. I've witnessed this pattern countless times across decades of market study. The operator who understands this principle, who can identify when a stock has completed its decline and entered the accumulation phase, positions himself alongside the smartest money in the market. The challenge, of course, is patience. You must be willing to hold through weeks or months of sideways action while others mock your dead position. You must resist the temptation to chase the hot stocks making daily headlines. You must trust your analysis and your understanding of market mechanics. Remember, the public operates on emotion and recent price action. The professional operates on logic, preparation, and patience. By learning to identify and participate in these quiet accumulation zones, you align yourself with the latter, and that makes all the difference between speculation and intelligent investing. There exists in the stock market a principle as reliable as any law of physics, yet it remains invisible to those who haven't trained themselves to see it. I speak of the relationship between contraction and expansion, between the compression of price action and the explosive move that inevitably follows. Consider a steel spring. When you compress it tightly between your hands, you're storing potential energy within its coils. The tighter the compression, the more force is contained. Release that spring and it explodes outward with power proportional to how much you compressed it. The stock market operates on this identical principle. When a stock enters a prolonged period of narrow-range trading, what we call consolidation, it is quite literally building energy for its next major move. Each day that price remains confined within a tight range, each week that passes without a breakout in either direction, the stock is compressing like that spring. Pressure builds, tension accumulates. Energy stores itself invisibly within the technical structure. Now, why does this occur? It's a matter of supply and demand reaching equilibrium, but an unstable equilibrium. During compression, you have two opposing forces locked in battle, those who wish to sell and those who wish to buy. Neither side can gain advantage. Sellers cannot push price lower, buyers step in. Buyers cannot push price higher, sellers appear. The result is a narrowing price range, often accompanied by declining volume as traders grow frustrated with the lack of movement. But here's what the uninformed fail to grasp. This very frustration, this apparent lack of opportunity, is what creates the opportunity. As the range narrows, as days turn into weeks of sideways action, weak holders grow impatient and exit. Stop-loss orders cluster just below support. Short sellers, seeing the stock's inability to advance, position themselves for a breakdown. Meanwhile, the operator continues his quiet accumulation, allowing this compression to work in his favor. I've measured this phenomenon across hundreds of stocks over many years. A stock that consolidates for 3 months will typically produce an advance lasting several months. One that builds a base for 6 months or a year. The resulting move can span years and multiply your capital several times over. The mathematics are straightforward. The horizontal distance traveled during compression measured in time tends to equal or exceed the vertical distance traveled during expansion measured in price. A 12-week consolidation within a 5-point range often precedes a 12-week advance of 15 to 20 points. The spring releases with force proportional to how tightly it was wound. This is why I counsel students never to grow impatient during these compression phases. The market isn't dead, it's loading. It's not wasting your time, it's building the foundation for significant profit. Those who cannot endure the quiet periods will never capture the explosive moves that follow. Train yourself to recognize compression for what it truly is. Potential energy waiting for release. Learn to measure it, to calculate from its dimensions the probable extent of the coming move. And above all, develop the patience to hold your position while that energy builds, knowing that the tighter the spring compresses, the more violent and profitable its expansion will be. Price, my students often discover, is merely the surface of the ocean. Volume, the actual transactions occurring beneath, reveals the true currents moving the market. A man who watches only price is like a sailor who watches only the water's surface while ignoring the tide. He may survive, but he'll never master navigation. When I sit before the tape, I'm not simply watching numbers flash by. I'm reading a story, a narrative written by the composite operator through his buying and selling activities, and the most revealing chapters of this story unfold during the refueling phase, when volume patterns expose exactly what the smart money is doing while the public remains oblivious. Let me teach you what to look for. During a genuine accumulation phase, observe what happens when price dips toward the lower boundary of the trading range. If heavy volume accompanies these declines, it indicates real selling pressure, genuine supply hitting the market. This is concerning. It suggests weak hands still hold substantial positions, and the operator hasn't yet absorbed the available supply. But if price touches or breaks below support on diminishing volume, now we're seeing something significant. Light volume on downswings tells you there's no selling pressure. The holders at these prices have already sold out during previous tests. There's nothing left to shake loose. This is precisely what the operator wants to see, and it's precisely what you should want to see before committing capital. Now watch what occurs on the upswings within this range. Here's where the operator reveals his hand to those trained to see it. When price lifts from the lows toward the upper boundary of the range, does volume expand slightly? Not dramatically, that would attract attention, but noticeably more than on the downswings. This divergence is your signal. Volume expanding on rallies while contracting on reactions indicates absorption. Strong hands are quietly taking shares from weak hands. I've spent 40 years studying these volume patterns, and I can tell you they never lie. Price can be manipulated for short periods. Charts can deceive. Tips and news are worthless. But volume, the actual transactions between buyers and sellers, reveals the truth of what's happening beneath the surface. Here's a practical example from my own experience. I once observed a railroad stock trading between 45 and 52 for 11 weeks. Each time it approached 45, volume dried up, perhaps 30,000 shares changing hands. When it rallied back toward 50, volume increased to 80,000 or 100,000 shares. This pattern repeated week after week. What was happening? The operator was absorbing every share offered during these rallies, building his position while keeping price contained. When that stock finally broke above 52 on volume of 200,000 shares, I knew the accumulation was complete. The subsequent advance carried it to 94 within 6 months. The volume pattern had telegraphed the entire operation to anyone paying attention. Train your eye to see these divergences. When downswings show declining volume and upswings show increasing volume within a trading range, you are witnessing the transfer of stock from frightened, impatient hands to patient, informed hands. Position yourself with the latter, and the refueling phase transforms from boring sideways action into the most profitable setup you'll ever find. There comes a moment in every accumulation campaign when the operator must ask himself a critical question: have I absorbed all available supply? Or do weak holders still lurk in the shallows, ready to sell into my markup and abort the advance? This question cannot be answered through hope or assumption. It must be answered through action, through what I call the shakeout. The shakeout is deliberate, calculated, and absolutely necessary. It is the operator's final test before committing his capital to the markup phase. And for those of us who understand its purpose, it represents the last opportunity to establish or add to our position before the real advance begins. Here's how it unfolds. After weeks or months of sideways accumulation within a defined range, say between 40 and 48, the stock suddenly breaks downward. It pierces the support level that has held repeatedly, perhaps dropping to 38 or even 36. Volume may spike on this breakdown, triggering stop-loss orders and creating precisely the panic the operator intends. The amateur trader sees this and thinks, the bottom has fallen out, the accumulation has failed, I must sell before further losses. This is exactly the reaction the operator desires. He wants these weak holders, those who bought during the range but lack conviction, to reveal themselves and exit. He wants the nervous money out of the stock. But watch what happens next, and here's where the tape tells you everything. If genuine supply existed, if substantial holders were truly liquidating, the price would continue downward on heavy volume. The decline would persist. Instead, within a day or two, sometimes within hours, the stock reverses. It climbs back above the support level it just violated, and critically, this recovery occurs on diminishing volume. This is your signal. The shakeout was successful. The operator has tested the stock below support, forced out the remaining weak hands, absorbed their shares, and discovered that no significant supply remains at these levels. The quick recovery on light volume proves that sellers are exhausted. There's nothing left to shake out. I witnessed a textbook example in a steel stock some years ago. After building a base between 62 and 70 for 4 months, it suddenly dropped to 58. Violating support by 4 full points. The financial press proclaimed the stock was breaking down. Stop orders were triggered, fearful holders rushed to sell. But within 3 trading sessions, the stock was back at 65, and within 2 weeks it had jumped to 76. That shakeout marked the end of accumulation and the beginning of a sustained advance that ultimately carried the stock above 120. The untrained eye sees the shakeout as failure, a breakdown signaling further decline. The trained eye sees it as preparation, the operator's final sweep to ensure clean sailing ahead. When you observe a stock violate support briefly, then recover quickly on declining volume, recognize it for what it is, not weakness but strength, not distribution but the final phase of accumulation. The shakeout separates the informed from the uninformed, the patient from the impatient, the professional from the amateur. Learn to recognize it, and you'll never again be frightened out of your position just before the most profitable phase begins. One of the most powerful principles I've discovered in 40 years of market study is this: nothing happens in the stock market without a cause. A stock doesn't simply double because the gods of fortune smile upon it. There must be a cause, a preparation, a foundation that justifies and enables such an effect. This is the principle of cause and effect, and when properly understood and applied, it allows you to project the potential extent of a stock's advance before that advance even begins. Imagine possessing such knowledge, to know while a stock languishes at 50 in a seemingly dead trading range that the cause being built is sufficient to carry it to 100 or beyond. The cause is the accumulation phase itself, the time spent building the base, the volume absorbed during this period, and the width of the trading range. These three elements, when properly measured, tell you how much potential energy has been stored, how high the spring can jump when released. Let me make this practical. I use the point and figure chart as my measuring tool. Each column of X's represents upward movement. Each column of O's represents downward movement. As a stock moves sideways in accumulation, building its base, these columns accumulate horizontally across your chart. Count them. A stock that produces 30 columns in its base, 15 advances and 15 declines within the range, has built more cores than one producing only 10 columns. The horizontal count translates to vertical projection. If your point and figure chart, properly constructed with appropriate box sizes, shows 30 columns during accumulation and the trading range spans 10 points, the mathematics suggest a potential advance of similar magnitude when measured from the breakout point. The more time spent, the more columns built, the greater the cause, and therefore the greater the probable effect. I've tested this principle across thousands of stocks. A base requiring 3 months to complete, with substantial volume churning through the range, consistently produces advances lasting 3 to 6 months. A base consuming a full year of sideways action. Such formations frequently precede advances lasting years and multiplying capital several times over. Here's what fascinates me: the market reveals its intentions to anyone willing to study. That railroad stock I mentioned earlier, the one building between 45 and 52 for 11 weeks, my point and figure count showed sufficient cause for an advance to approximately 90. The actual high was 94. The steel stock accumulating between 62 and 70 for 4 months. The count projected 115 to 125. It reached 122 before showing distribution. This isn't mysticism or guesswork. It's measurement. It's understanding that accumulation creates potential, and the extent of accumulation determines the extent of markup. The operator cannot push a stock up indefinitely on thin accumulation. He needs fuel shares absorbed, time invested, a proper foundation built. When you identify a stock in the refueling phase, don't simply note that accumulation is occurring. Measure it. Count the columns on your point and figure chart. Calculate the cause being built. This measurement tells you whether you're looking at a stock that might advance 20% or one preparing to double. The market rewards the patient and the precise. Build your position during the cause, hold through the frustrating sideways action, and the effect, the doubling or tripling of your capital, becomes not a matter of luck, but mathematical probability. After months of patient observation, careful analysis, and disciplined accumulation alongside the operator, there comes a moment when the entire character of a stock transforms. The refueling phase ends. The markup phase begins. And this transition doesn't occur randomly. It announces itself through specific, identifiable technical events that I call the spring and the jump. The are your launch signals, and missing them means missing the opportunity to enter at the most advantageous moment, or worse, exiting just before the explosive move you've been waiting for. Let me describe the spring first. You've been watching a stock consolidate between 55 and 63 for perhaps 5 months. Support at 55 has held repeatedly. The operator has been accumulating quietly. Volume patterns confirm absorption. Your point and figure count suggests substantial upside potential. Then suddenly the stock drops to 53, violating that well-established support level. This is the spring, the final shakeout I described earlier, but with a critical distinction. The spring is characterized by its brief duration and sharp reversal. The stock may spend only 1 or 2 days below support, sometimes mere hours. Then it snaps back decisively, like a coiled spring released, often closing back within the original range on the same day or the next. This violent reversal on expanding volume tells you something profound. The operator has tested for supply one final time, found none, and is now ready to begin his markup campaign. The spring eliminates the last weak holders, triggers their stop losses, and clears the path for sustained advance. But the spring alone isn't sufficient confirmation. You must wait for the jump. The jump occurs when the stock, having sprung back from its test below support, now breaks decisively above the upper boundary of the accumulation range. In our example, after springing from 53 back to 57, the stock would jump through 63, perhaps to 66 or 68 on unmistakably heavy volume. This is the operator showing his hand. He's no longer hiding. He's marking up his position, and he needs volume to do it because he's no longer absorbing supply, he's creating demand. I witnessed this pattern unfold perfectly in a copper stock years ago. After 7 months, between 71 and 82, it sprang down to 68, recovered to 75 within 2 days, then jumped to 88, on volume triple the recent average. That jump was my signal. The stock ultimately reached 156 within 18 months. The beauty of the spring and jump combination is its clarity. You're not guessing about the operator's intentions. You're not hoping the accumulation is complete. He's showing you explicitly through price and volume action that the refueling phase has ended and the markup has begun. Many traders enter too early during the accumulation and lose patience. Others enter too late after the advance is well underway and risk is elevated. The spring and jump pattern provides the optimal entry point after accumulation is confirmed complete, but before the major advance has consumed its potential. Watch for this 1-2 sequence, the spring below support that quickly reverses, followed by the jump above resistance on expanding volume. When you see both elements in succession, you're witnessing the transition from preparation to execution, from accumulation to markup. This is your signal to act with conviction, for the doubling you've anticipated is now underway. I've trained hundreds of students over the years, and I can tell you with absolute certainty that technical knowledge is not what separates the successful from the unsuccessful. Most who fail in the market understand the principles I teach. They can identify accumulation zones. They recognize volume patterns. They can count point-and-figure charts and calculate projections. Yet they still fail. Why? Because they lack the one quality that cannot be taught through charts or diagrams: patience. And in the stock market, patience isn't merely a virtue, it's a position, it's capital itself. Consider what accumulation demands of you. You've identified a stock building a base. Your analysis confirms the operator is absorbing supply. Volume patterns support your conclusion. The point-and-figure count projects substantial upside. Everything is aligned perfectly. Now what must you do? Nothing. Absolutely nothing. You must sit. Wait while the stock meanders sideways, day after day, week after week, perhaps month after month. This is psychological torture for most traders. Their capital sits idle while other stocks make exciting moves. Friends boast about quick profits in the hot stocks being promoted in the financial press. Doubt creeps in. Perhaps I've misread the situation. Perhaps this stock is truly dead. Perhaps I should sell and deploy my capital elsewhere. This is precisely when the amateur fails and the professional succeeds. I learned this lesson painfully in my early years. I identified a manufacturing stock in perfect accumulation, bought my position at 34, and watched it trade between 32 and 38 for 9 months. 9 months. Meanwhile, a mining stock was making headlines, advancing spectacularly. I sold my manufacturing stock at 36, a small profit, and chased the mining stock. Within 6 weeks, the mining stock collapsed, costing me 40% of my capital. The manufacturing stock, it jumped to 52, then 68, then ultimately to 94, exactly as my original analysis had projected. I learned that day that patience isn't passive. It's the most active decision you can make. When you hold a properly analyzed position through the refueling phase, you're not doing nothing. You're doing everything. You're maintaining discipline while others panic. You're trusting analysis over emotion. You're positioning yourself with the operator instead of with the crowd. The operator himself demonstrates this principle. He doesn't rush his accumulation. He takes the time necessary to build his position properly, regardless of how boring it appears or how long it requires. He understands that premature action, buying too aggressively, marking up too soon, would undermine his entire campaign. You must adopt this same mindset. When your analysis confirms accumulation, your position becomes your patience. Every day you hold through the sideways action, you're compounding your potential profit. You're allowing the cause to build fully, ensuring the effect will be proportionally powerful. The market will test your patience repeatedly. It will tempt you with more exciting opportunities. It will bore you with inaction. It will make you question your analysis. These tests aren't accidents. They're features of the refueling phase, designed to separate those who understand market mechanics from those who merely react to price movement. I tell my students, if you cannot endure 6 months of sideways action, you don't deserve the 6 months of explosive advance that follows. The profit isn't a reward for being clever, it's compensation for being patient. Gentlemen, we've journeyed through the complete anatomy of the refueling phase, from the silent accumulation zones where smart money operates unseen, through the compression that builds explosive potential, to the volume patterns that reveal truth, and finally to the spring and jump that signal the transformation from preparation to profit. But let me leave you with this essential understanding. The stock market is not a casino where fortunes are made through luck or speculation. It is a battlefield where preparation meets opportunity, where knowledge confronts ignorance, and where patience invariably triumphs over impulse. The refueling phase, this seemingly dormant period that frustrates amateurs and bores the undisciplined, is where fortunes are actually built, not during the exciting advances that make headlines, not during the panics that create drama, but during the quiet months when the composite operator methodically builds his position while the public looks elsewhere. You now possess the knowledge to identify these phases. You understand how to read volume, measure cause, recognize the shakeout, and spot the launch signals. But knowledge without application is merely an interesting conversation. The real question is, will you have the courage to act on this knowledge? Will you have the discipline to buy when a stock appears dead and hold while it appears lifeless? I've shown you that stocks don't double by accident. They double because substantial cause has been built during the refueling phase, cause that you can measure, calculate, and anticipate. The operator spends months building this foundation, not because he enjoys waiting, but because physics and mathematics demand it. You cannot create a large effect from a small cause. Your task then is straightforward. Identify stocks in genuine accumulation, verify the operator's presence through volume analysis, measure the cause being built, exercise the patience to hold through the refueling phase, and recognize the spring and jump when the markup begins. Do this, and you position yourself not as a speculator hoping for lucky breaks, but as an informed operator participating in the market's natural cycles. You transform from someone who reacts to price movement into someone who anticipates it. You become the patient accumulator rather than the anxious chaser. The stocks that will double in the coming months and years are refueling right now, building their bases, absorbing supply, compressing their energy while the crowd ignores them. They're waiting for those disciplined enough to recognize the pattern, courageous enough to take position, and patient enough to hold. The market will always reward patience backed by knowledge. It will always punish impatience disguised as action. Choose your path wisely, study diligently, and remember, in the stock market, those who wait upon proper cause will always harvest the most substantial effect. Now go forth and read the tape with understanding. The refueling phases are there for those trained to see them, and the doubling of capital awaits those disciplined enough to participate.